In our strategy, risk is tracked through a 5-phase cycle. Sequencing matters more than timing. Optionality matters more than conviction. Markets are pushing higher, but signals are moving underneath the surface. This setup rarely breaks immediately, but when it does, the next phase arrives faster than most expect. By the end, our strategy will map what changes, what does not, and which signals matter first. Today, our strategy is reviewing David Lin's conversation with Keith McCullough. The discussion frames the current environment as momentum-driven, with real assets and cyclicals leading. This is not about headlines. It is about how the system is behaving. The core claim is straightforward. Ignore narrative noise and follow the numbers. Growth is holding up, inflation pressure is cooling, and momentum is being rewarded. In our strategy, that combination aligns most closely with Phase 1 behavior. Risk assets can continue higher, even while sentiment feels uneasy. That disconnect is not unusual late in an expansionary sequence. Here's what most people miss. A risk on tape does not mean a low-risk system. When inflation cools and activity remains firm, financial conditions can loosen. Looser conditions tend to reward trend persistence and participation. That is the engine behind momentum-driven phases. The video highlights strength across gold, silver, and industrial metals. In our strategy, metals act as confirmation signals. They reflect policy credibility stress and global demand stabilization. Gold behaves more like a monetary asset. Silver carries more industrial sensitivity. That makes silver higher beta, and also more fragile when conditions shift. Hold this thought because this matters for sequencing. If metals lead while equities hold, Phase 1 can extend. If metals fade while equities float, fragility increases. The conversation downplays directional dollar calls. Our strategy translates this into a funding question. Is global liquidity easing together or quietly diverging beneath the surface? Yen weakness is not just a currency story. It reflects policy divergence and funding stress transmission. This is a monitoring signal, not a forecast. Softer job data is framed as acceptable. In our strategy, that logic holds near term. It keeps policy from tightening while consumption remains intact. Phase 2. Pressure rises when liquidity stops improving. That is when multiples compress even if growth still looks fine. The video is optimistic, but our strategy keeps this conditional risk active. Quick disclaimer. This is educational macro commentary, not financial advice. This is where it becomes actionable. Our strategy respects momentum, but plans exits before momentum fails. This setup modestly lowers near-term Phase 2 probability. It does not confirm safety. It increases sensitivity later if positioning becomes crowded. In our strategy terms, forced opportunity windows still appear early. However, conditions are approaching ladder watch territory. Not a buy window, but no longer distant. These are not buys. These are the tickers most sensitive if this regime persists. SPY for broad participation. SMH, AIQ, and chat for higher beta leadership behavior. TLT and ZROZ function as sequencing tools. They matter if yields stall and roll. They matter later if convexity returns. Gold and silver for policy credibility. Oil and copper for global demand confirmation. EEM for dollar sensitivity. BTC as a liquidity beta signal, not ideology. Before this data, Phase 2 risk sat in a moderate range. This environment nudges that probability lower near term. Not certain, but closer to continuation than breakdown. More respect for momentum, tighter monitoring of metals leadership, clearer exit triggers if breadth fades. No narrative overrides, no single entry decisions. Optionality remains valuable. Credit spreads widening would change phase pressure. Rising long yields with cooling growth would change sequencing. Metals leadership breaking would weaken confirmation. Which signal would break first if conditions turn fragile? Credit or breadth? And are you seeing confirmation yet? Or does it still feel early? Our strategy can respect a risk on tape without becoming captive to it. We do not need to be early. We just cannot afford to be late.